think the takeaways are definitely positive. When you look across the earnings season so far for the banks, whether it be the big money center banks or some of the larger regionals that you've heard from so far, I think the key trends are that we're seeing an inflection in deposit flight. That was very clear from Schwab, and I think that's why you saw a number of the regional banks start to increase and maybe hold the bottom. You didn't see any fallout from them, which is definitely encouraging. I'd say the key point to follow is more of the regional banks start to report is what happens with commercial real estate losses, because you did see loss provisions pick up at JP Morgan, Bank of America. They are up 20, 30% year over year, albeit from a small base, but that didn't derail the earnings. It didn't derail net income. And I think the big takeaway that we need to be cognizant of with respect to this economic story is that the consumer remains in really, really good shape. The consumer has continued to surprise to the upside. And I think that has provided a lot of support, not only for the economy as a whole, but for corporate earnings. So anyone who's been calling for this earnings apocalypse for the past 18 months, it just hasn't materialized. And I really don't think it's going to. And so when I talk to our clients, the big message is with the more benign economic backdrop, I think that allows risk assets to continue to move higher. I just think the path is going to be a little bit bumpy because there are a few cracks that we're starting to see. Deal flow for banks is improving, but it hasn't improved. And so there's still some room to go. So I think financials look good. Still not my favorite place for investment opportunities. I'd still be looking to other cheaper places like healthcare or industrials that have a little bit more, I'd say, earnings horsepower and that are more tied directly to what is improving and working in the economy right now.
Matt, I just want to dig into that a little bit more because it is the same assumption that I arrived at. The fact that the consumer resilience was a big theme that investors picked up on the trade yesterday around the banks. Also, the clearing of the hangover from the banking crisis earlier in the year. But that trade doesn't seem to have a lot of legs at this point because if we look at some of the underlying factors in the banks still, it wasn't what it looked like in 2022, right? Not the boom years that we've had. And it feels like there's a huge amount of cost cutting that really is just sustaining these bank numbers at this point. What do you think?
Yeah, I mean, expense cutting is definitely evident. You saw that with Morgan Stanley. You've seen that over the past year, like you noted, Karen. I think that's a result of the capital markets activity, broadly speaking, still being in the doldrums. So, like I said, deal flow is improving. It's not great. M&A activity is what's really, really lagging. I think there are some encouraging signs, though, because when you look down the market cap spectrum, deal flow for smaller companies, whether it's buyouts, takeouts, that has been improving. So if that can translate up market cap to some bigger deals coming through, maybe this Activision, Blizzard, Microsoft deal coming through helps thaw sentiment around deal flow as well. You still have some question marks around the FTC, what they're doing with some larger healthcare deals. I think if those go through, that might help improve sentiment around deal flow, and that might help accelerate some of the earnings for a lot of these banks as well, because it has been driven by a lot of other departments, and you need to see deal flow come back in order to really have the leverage that you need to get sustainable improvement in margins going forward.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.